Hey everyone, Value Add Mike here today to give you a tip on how to invest in the commercial real estate markets of today. So, as everyone has heard, the recession is coming, the interest rates are too high, the world is pretty much ending. But does that mean you should stop investing in real estate? Absolutely not. That is never the answer. Always keep looking at deals, looking at opportunities, and making sure that you're building up for your next deal. But what should I look for in the next opportunity, you may be asking? Well, today I'm here to give you three tips that I look for when finding my deal, and I think every LP investor should be looking at moving forward. First thing I would say is look for a lower leverage deal. So in the past year, I would say I've seen loan to values of 75 or greater, 75 to 80% loan to cost to pretty much fund the renovations. But I think now where we are in the market cycle, I've been underwriting 60 to 65% loan to values or even a little bit lower, only because I've seen and I've read a lot of different books of like $1 billion portfolio. But if you're within that 60 to 70% loan to value range, what happens is if the market takes a 30% dip, not saying that it will, but you're playing defense with your debt. And so if the market dips 30%, you're not upside down on your mortgage because you have a lower leverage deal. So making sure you're playing defense with your debt on that piece. But I think another thing that's mission critical when looking at your debt is the bigger the loan that you have, and with rates and prices still going up, the bigger the rate or the more loan you have, the more your cash flow is getting up because your interest rate has gone up probably from last year 3.5 to now 4 to 5.5, 6% interest rate. So when that interest rate goes up, your cash flow is going away much quicker. So we like to do lower levered deals because we could find some cash flow, and generally too, when we do a lower leverage deal, our bank allows us to do interest only loans for longer periods of time. So instead of a year ago, we may be getting 2 to 3 years of interest only. We may be getting 3 to 5 years of interest only because we're doing much lower debt leverage. So super important that you understand that you play defense with your debt by not going over leverage so you don't go upside down. And two, you're not eroding your cash on cash. So that's the first bullet point. The second bullet point I think it's super critical is only investing in really strong markets and submarkets. So in the previous video I've done is showing the population or the market and submarket, but I think it's really honing in on being really close to the strong submarkets and markets. So being in Nashville is a very good market. Being in Denver is a really good market. We're getting less and less, we're getting more and more cautious of being in those more tertiary markets unless they have strong population growth and strong job growth. We have a property that's 45 minutes away from Nashville, which may be more deemed tertiary, which I agree with, but we really like that market because it had over 2,000 jobs being already announced, with more coming into that submarket. And because of that, we took a property of 4.4 million in value and increased the value up to 7 million in 1 year. So by being in those really strong markets that show job growth and population growth, it allows to increase the demand because housing is a very critical need, and just making sure that we are providing that safe home for our residents in those communities. So look at job announcements on Google, could be a critical way. Amazon announcements are always huge, but you may have to pay a premium for those. But I'm less likely to look at more tertiary markets because if a few job employers move, also if a few employers move, then the likelihood of you succeeding in that business plan goes down. Plus, you have less talent in that area because there's just deemed less population. So just super critical to invest in strong markets that show population and job growth and give you as many exit strategies as possible. And the last thing that I think is super critical when looking for an investment is looking for a team with experience and know-how. And I know everyone says know, like, and trust, but I think the biggest thing is making sure that you have a team that has a track record who's done that business plan and has executed it versus them trying to do a new business plan. So, for example, I wouldn't want to invest in a team that's done a lot of existing multifamily and now they're doing a hotel conversion, unless they have a partner that has experience turning hotels into multifamily. I wouldn't take my background of buying market rent apartments and then trying to do a Section 8 deal because I don't have the know-how or the know-how to do that and execute that business plan well. So for make sure you have like experiences when investing, because the last thing you want to do is be a guinea pig for a new project for an existing group. So make sure they have experience executing that business plan, executing that strategy, and also executing in those markets, because I think that's super important for you as an investor to know. So appreciate you watching this far. Just to summarize really quickly, continue to look for deals, look for lower leverage, look for strong markets and submarkets, and lastly, look for teams that have experience and know-how in doing it. If this video gave you any value, please like, comment, subscribe, share with a friend. Would really appreciate it, and post your comments. And until then, we will see you on the next video.